Gold is at records, silver sprinting, but all of us are still calling them hedges. Lately, they've been more volatile than equities, and that is not comfort, right? That is crowding, and that is what we call as FOMO, or fear of missing out. Let's just look at the story from ground up to get some more perspective. Hello everyone, welcome to Money Mastery with Sadik. Gold is ancient money and silver was the people's money. And you fast forward to today, most of the gold that is ever mined is still around, right? And silver does get used up more than gold. And mining wise, gold mining projects can respond slowly to price, whereas for silver, 70% of silver that is mined is as a byproduct of other metals such as copper, lead, or zinc, right? So the supply of silver doesn't just jump because price is going higher, meaning silver's supply is a bit stubborn and sticky. As of today, we have mined around 216,000 tons of gold in history, which is a giant salvageable stock or inventory of gold that keeps recirculating around the world as gold bars, as jewelry, as coins, as ETFs, and as part of the storage vaults, etc. Right? Silver has big identifiable stocks too. Most of the above ground stock, it's just tied up. A lot of silver sits in ETFs, in vaults in London, and long-term investors' hands. So the free float that can hit the market quickly is a lot smaller than the total inventory, which is another reason why prices have been going up so quickly. It is estimated that the total above ground silver that has been mined till date is around 1.77 million tons, of which majority are lost or are practically unrecoverable. It is estimated that only around 6 lakh tons of silver is usable or is in marketable condition. The demand for gold is mostly as investment, as government reserves, as jewelry. Especially the central banks around the world consider it as a storage of wealth and diversification of reserves, especially away from the US dollar, right? In fact, there is a report that states that gold makes up more than 30% of central bank reserves, which has more than doubled from around 15% in the last decade, right? That is massive, right? And silver too, kind of wears two hats, one as a precious metal and the other as an industrial metal, right? It has applications in solar, in electronics, in auto manufacturing, etc., which kept pulling silver even when investors were not big buyers, right? Globally, the 2025 landscape is simple, right? We're seeing central banks buying of gold, which is ensuring that gold remains structurally strong. And there's also this de-dollarisation chatter or noise that doesn't seem like it's going to go away anytime soon. And we're also seeing the macro jitters with the tariffs, with issues between US and China and Russia, Ukraine, or the Middle East and things like that, right? And on top of it, we are also seeing the AI frenzy, which is also, giving investors some nervousness, which is also keeping the safe haven bid alive for both gold and now also for silver. In India, both gold and silver often trade above global quotes for two simple reasons, right? First, there is a built-in sort of tax wedge or gap in the form of the 6% import duty before the metal lands in the country. Plus, there's also this 3% GST to the end consumer who is buying these metal, right? And second, there is also this physical tightness that we are witnessing right now. There's this festival demand, and also there's this frenzied, investor buying and industrial pull or demand, all of which can make delivering gold and silver bars sort of scarce, right? And when supply is tight, the spread between the prices of these metals in India versus the spot price internationally will widen, and we can also see that in the local spot versus MCX prices, right? And also due to extreme levels of demand, even ETFs have sort of paused fresh unit creation because sourcing of bars, especially silver bars, gets costly, and it is also becoming difficult, right? And globally too, we are noticing silver is in backwardation right now, where the spot price is trading above the price of the futures contracts, because physical bars in key trading locations such as London are tight, and lease rates, which is basically the rent that traders pay to borrow silver, has shot up massively, right? And that's sort of a classic behavior of a price squeeze, right? And meanwhile, with the whole AI trade looking a lot crowded, and a lot of investors' fingers are sort of hovering around the sell button, and when big tech wobbles, money sort of rotates into safe havens or hedges. And also because bond yields are lower, there's a lot of appetite for gold, so that is keeping up the price of gold first, and then silver too next. And that nervous hedge flow of money is part of the 2025 melt up of both of these metals, right? Here's the uncomfortable bit. Hedges should ideally not be as volatile as our underlying equity portfolio, right? Silver's supply deficits and it being a byproduct supply with investor FOMO has created air pockets, which can result in prices going up fast, but the falls can also be more severe, right? And India's current silver tightness and the premiums, the import frictions, all of these sort of fits the late cycle pattern too. We might still go higher from here, but very high concentration or big lump sum investments into these metals kind of looks risky at this point, in my opinion. In fact, after the 1980 spike of silver to about $50, the metal didn't sustainably reclaim those highs for about 4 decades, right? That's like 40 years. That underscores how brutal the drawdowns and waiting periods can be, especially for late cycle investors, right? And also gold's 1980 peak wasn't meaningfully exceeded until the late 2000s, roughly 27 years later, reminding us that even safe havens can go through very long flat to down stretches in nominal terms, right? I'm not downplaying their value. Demand and supply has evolved for these metals, and with global uncertainty still lurking around and not showing any indications of dying down anytime soon, the long run case is still very solid, right? But then this data suggests against heavy concentration in these metals. Many Indians are also investing in gold through sovereign gold bonds, SGBs, buying them in the secondary market because the government has not been issuing them of late. But then when they buy it in the secondary market, they pay a really fat premium, right? One thing that we need to remember is the 2.5% annual interest that gets paid on these bonds is on the original face value of the bond and not on the premium price that we pay when we purchase it in the secondary market, right? So if gold price corrects, these premiums can evaporate quickly and investors might see a loss, right? So the first rule is to cap the allocation of gold and silver at 10 to 15% of the overall investment portfolio, with higher weight to gold compared to silver. And remember, these are hedges and these are not the main dish, right? And buying gold in the form of jewelry comes with additional cost in the form of making charges, wastage, etc. And as discussed, buying SGBs from the secondary market could end up being a trap in case gold prices turn south. In my personal opinion, the best option to invest in gold is via ETFs, or if you're someone who invests through mutual funds and most of your allocation is in equities or fixed income with not a lot of allocation to gold and silver, then probably you can discuss with your financial advisor about allocation to multi-asset funds. So that way there are professional managers who can manage the investments and asset allocation based on market movements and volatility, right? And also skipping big lump sums or concentrated bets on gold and silver at these levels it could be optimal, right? If you must add them to your portfolio, maybe do it in small amounts and space the investments out. These metals are going to be available to invest for a long time, and there will be better opportunities to buy them cheaper. And when the price corrects, maybe at tiny bits, like still trying to maintain the whole 10 to 15% asset allocation band, right? There are tailwinds such as central bank buying, stocking up, gold as reserves, and the astronomical, levels of American debt, which could end up hurting the dollar, accelerated by geopolitical issues that is going on around the world, with America being the center stage of many of these problems, right? So these factors should support gold to rise further, and the favorable demand supply mechanics should also propel silver in the long run, right? But let us always remember that irrespective of where these metals trade today, on our investment portfolios, it all depends on the price that we pay, right? So that is what will determine if we are making a higher ROI on these investments, right? So think of gold and silver like, seat belts. Wear them, but don't worship them, and don't FOMO thinking that the prices will not come back down. Keep the allocation suitable to what is suitable for your investment profile, and maybe use ETFs to invest in these metals, and nibble on dips instead of FOMOing and investing lump sums, right? So long-term demand and global jitters can keep the prices elevated, but our job is allocation, not adrenaline. Big thanks for watching. If you found this video useful, smash the subscribe button, tap the bell icon, and share it with one friend who needs it. Your comments will shape the next video. See you there. Thank you.